The process of accumulating wealth is as much about the mindset as it is the successful execution of a strategy. But how important? Ron William, technical analyst, market strategist and trader, joins us now to look at the approach that he advocates. How important do you think this comparison between the strategy and the mindset is?
It's paramount, as with all psychology mindset areas, and no other area than money polarizes the human condition. People either love it or hate it. And in the book, the famous book by Napoleon Hill, Think and Grow Rich, he interviewed over 500 very affluent, wealthy people back in the 1930s to prove exactly that the thought in the human mind made all the difference when it came to wealth.
Yeah, let's introduce our first slide here. It's a slide that we have already seen from you in your previous interview with us about trading psychology, and it's this idea of this iceberg. You can only see a small proportion of what is a very big and deep story.
Yes, and the deep story is the bigger and most important story, because it's the one that drives our decision making, whether it be trading strategy, risk management or logical behavior. Whatever might seem rational is important, but what really controls that is the submersive nature of our human condition, and that's our values, perceptions, habits, beliefs and fears. But when it comes to money, that really is amplified even more.
Yeah. So what formula do you follow? What blueprint is there that we should follow in order to get to our goal that we've set?
Well, the first thing is self-awareness. Be aware of the beliefs that we associate with the concept of money and wealth. And on the following slide, we've just got 3 examples on education, capital and risk. And on the left side, we have the not so great belief, and on the right side, you know, the better one to strive for. So for example, in terms of education, people might say on the negative side, only experts know how to make money. So we need to be smart to make money. Let's leave it for those people. Whereas of course the flip side to that is financial education can teach us how to make money. Second to that, capital. I don't have any money to invest. I've heard that many times, and I've been told that many times early on in my career. Or the flip side to that, I have enough money and don't need to invest. So those who are capital rich just don't feel the necessity to rich. Of course, the flip side to that is if with or without not managing money basically reaches the stage where money will not be there to manage in the future. So it's very important to actually just learn the skill set either way. And finally, on the risk side, losing money is okay. I can win it back on the next trade. So this idea that it's just a gamble, it's the luck of the draw, so wrong. And I hope very few people do that nowadays. Of course, the better mindset focus to have is risk management is paramount. It is the difference between winning and losing. Don't risk more than X%. The average is usually 2% for a trade account and slightly more for people who are investing.
What is the process you advocate in making this approach?
Well, all of these beliefs are neuro associations. So in our last interview on trade psychology, I spoke about the biochemistry that actually happens to the mind, the physiology and the emotions of human beings when we start to think this in certain ways. We actually reprogram our supercomputer for better or for worse. So the first way is to be aware of whatever programs we're running, and it's something that we should really take seriously. And so here's a good program we can all maybe try and wear on for size, and that's this breakdown of the word wealthy. Write down your goals. We miss 100% of the goals that we don't take, so it's very important. One of the first things I tell traders and investors is write down what it is you want to achieve, be specific and be brave about those goals. Envisage your futures. Many athletes actually practice, and it's been scientifically proven that any kind of visualization, whether it be sticking something up on the board or just literally using mindful techniques, helps to condition the mind to actually aim for that goal. Affirm the desire, because of course just doing a one-off momentary thing will fizzle out over time. It needs to be repeated again and again and again to continue the process. And then One thing which I think is important nowadays is to affirm the desire, just to really kind of ground it into oneself and to believe in it from a emotional perspective. In the middle there, listen to your inner voice. I say that in terms of the gut instinct that really is there guiding you, giving you the moral compass guide in life, but also to filter out all the noise out there, including all the other voices going on in our heads, which tend to lead to self-sabotage. So listen to the one voice which is really guiding you where you want to go along that wealth path. Take action. It's the best thing best cure for procrastination. Taking action and then taking that action into a transformational process where you're actually changing from one area to another. Hold the vision, and there's a wonderful chapter in Think and Grow Rich where it talks about being 3 feet away from gold. So it's just before we're about to actually make the good trade, and it's after a few bad trades that we give up. Hold the vision all the way through those consecutive losses, because they will see you to the finishing line. And then finally, you're in control. This is quite an important one during crisis situations, whether it be an economic crisis or a personal crisis. Always keep in mind that you're setting the sail of the yacht that you're in, the boat that you're in. And whatever storm comes by, you really need to just focus on that wealth strategy.
And of course, this is top right-hand corner, roots to fruits. I like that. You've got to have the roots, you've got to have the foundation in order to benefit from the fruits of your labour.
Yes, well, I mean, a lot of the issues and the challenges to having that wealth mindset are deep in our roots, and that's a combination of either nature, our personality traits, or nurture, things that we've maybe inherited from our parents, or even in some cases people now proving DNA are passing on, or just environmental things, education and work experiences. But the point is, whatever the cause, our biography is not our destiny. And so by understanding our roots, we can actually transfer them into the fruits, and then actually change in the way that we need to be in order to make that money. And of course, this is actually one of the reasons why, for example, a lot of lottery winners tend to lose the money at the end of the game, because they haven't gone through the process of being wealthy before getting the money, and so the money is lost. So it's a proven statistical fact. And the last point I want to make, actually, which fits in with this whole get rich quick myth, is let's get rich slowly. And there's a lot of material built onto this theory, which is practice. And one thing I always like to tell traders and investors that I work with, particularly traders, if you're trading just targeting 0.5% per week, that equates to 2% per month. 2% per month equates to 24% per year, if maintained on a consistent basis. And last but not least, extrapolate that 5 years, which is always best to do a long-term plan, 5 to 10 years. 5 years, that equates to about 120%. So phenomenal results. Maybe too good to be true, but all of this stuff can be broken down into baby step approaches, which are really the best way to go. And consistency is really the name of the game.
Yeah, but in order to get to your end goal, you've got to adopt a strategy. I mean, there are lots of potential strategies out there, and I think on the next chart you've got some interesting ideas here. How do you go about building a strategy?
Well, we just covered the mindset side, and so that's the most important starting strategy. But then the practical strategy in terms of lifestyle strategy, which is our next slide, is also just awareness of what we're doing outside of trading and investing. Because, of course, most of us have full-time jobs or various professional commitments. And so it's important to understand our cash flow and how that circulates, for better or for worse. And so in the works of a gentleman called Robert Kiyosaki, who's a financial educator, he developed this idea of a cash flow quadrant. He basically sliced and diced the world population into 4 sections. And on the left side, where most of us reside, we're either employed or self-employed, but essentially we're selling our time for money. Now, we might be passionate about what we do, but the simple averages say that we don't earn much of the world's wealth. We tend to pay more taxes, and we tend to be more limited in our time, just because we're mandated to work the hours that we do. Now, if we're Self-employed, that means we own the job as opposed to having the job. And the idea that anyone on the left side, employed or self-employed, at some point is attempting to migrate to the right side where they have a business or nowadays an internet website where they can scale out the McDonald's franchise type model and have people work for them. They develop a system of some sort. Think of the Facebooks of this world. Or on the lower right-hand quadrant, the investor, and I think that's where most of your viewers are aiming for. That they still keep the job, but they're also now diversifying into investing, and this is where we're starting to develop more passive income. So before we even start trading and investing, we're just thinking about this idea of active money, where we have to trade our time for money, versus passive money, where it once we've built it, it continues coming in no matter what. And just as a segue on that point, one of the ways to begin, because it's the first question I get asked, is, okay, this is all great theory, but how do we start? The way that I was taught to start, and I try and teach other people to do the same, is just be aware of our accounts, have strict accounts, and instead of spending everything on whatever we spend it on, whether it be bills or fun times or leisures that we want to do, divide it into at least 3 areas. So start with managing our own money. Everything starts at home. And that's, so of course, the first thing is our own expenses. So the spend bucket, the save bucket, and the share bucket. Save basically can be saving some money for a saving account or for an investment account. I recommend both. Share is something that some people understand from just a goodwill perspective. It's the attitude for gratitude, and often when we actually start to give, whether it be a charitable cause or whether we're supporting some good cause, it tends to come back tenfold. So it also frees up this mindset of scarcity, that we don't have any money to give. But all in all, the idea of actually dividing up our cash from the word go actually helps with managing the money that we invest in trade, because if we can do it with our own money, then we can do it with a trading account too.
And at the same time, never lose the sight of the power of compounding, which I noticed on the bottom right-hand corner. You talk about that. I think it was Einstein, wasn't it, that said it was the 8th wonder of the world, I think. Is that right?
Well, absolutely. And many people contend with, support that view. Tony Robbins, in his Money Mastery book, where he interviewed the world's top hedge fund managers, that was one of their top points. They said, through all the crisis events, compounding still survives. Yes, it will suffer drawdowns, as everything does, but the earlier you start, and that goes out to all the millennials watching, the more they can save. And it's just the power of maths, basically. It is what it is. And it's a small amount. And I think the way that it's described is, think of it as a second tax. So we all, have to pay our taxes at the end of the month or the year, but just add your own personal tax, where a certain amount of the income is just given up, knowing that will go to some kind of freedom bucket, or just some rainy day account, which makes all the difference. And this all changes the mindset when trading and investing, because if we're trading with all the money that we have, which is the point that we'll get to soon, that produces the worst outcome, because it's survival state and make or break type of decision making. So it's really important to have options, to know that you have some kind of comfortable cushion to build on.
So I've heard the phrase, taking care of the pennies, the pounds take care of themselves. How about money management? I mean, that's a very simple concept, but in your approach to this, what do you teach about money management?
Yes, well, money management is a practical, step-by-step, rule-based system that needs to be abided by. Without it, the strategy doesn't make a difference, and the best mindset won't sustain itself, because we haven't managed the capital correctly. So I have 7 golden rules. I tweak them from time to time, but essentially the first one is balanced mindset. So it does begin with the mindset point of view, because if we're in a survival reactive state, that won't be good for the focus. Balanced mindset and a peak performance. So we need to maintain our mind, body, and emotional state, which is something we covered in our last interview. Second option, real money only with tested strategies. So of course we've got to make sure that before we even commit any money, the strategy's got to be viable. So some kind of manual or quantitative-based test of the strategy just to prove that more often than not it's worked. And it's all about probabilities, not certainties. So let's prove to ourselves that the probabilities are in our favour from the word go. The third point is only invest with risk capital, just a point that I mentioned just before. I think all too often people trade with money they should not be trading with. It's committed elsewhere on whatever project or lifestyle commitment, and it's just a big no-no. Trade with risk capital. And for some people who maybe might not have the capital at hand right now in terms of that perfect figure they have in mind, start to build up the account over time, a monthly amount, set it aside. You can maybe trade with that amount, or just wait until a certain time target has been achieved and then trade. But the worst thing you can do is trade with something that shouldn't be traded with, or with too little. When I say too little, that falls into some other points that I talk about in terms of the percentage that needs to be traded. And that comes into our fourth and fifth point in terms of the allocation of money, which is very important. Most people agree that a maximum of 10% should not be so a maximum should be invested, not more, because that avoids any kind of negative equity situation. Let's say all trades don't work out. You want to make sure there's enough money in the account and the account hasn't been compromised. As a build-up to that, but on a microcosm basis, there should be a maximum of 2% on a single trade. And if you just do the math, let's say it's 1% per trade or 2% per trade, but the idea is mathematically you will remain in equity, and that just avoids any kind of consecutive loss basis. I often find that people get very stressed on a trade that isn't going their way. The best way psychologically to actually deal with that is to reduce the risk. So if you're on 2%, drop it to 1%. If you're 1%, drop it to 0.5%. Whatever it takes to get below the pain threshold of, psychologically, and it will improve your results. Remember, it's get rich slowly. There is no rush. There should not be. And then the sixth point is intelligent diversification. This is a widely heated point, but there are many leading money managers that still support this, and it's a crisis hedge for the most part. And I think on the cusp of the 10-year anniversary of the global financial crisis, 1 year plus, it would be a good idea for us to be more risk averse than usual. It's certainly not the time to be devil's advocate and just continue to stand in front of the steamroller just to pick up that last penny. It's much better to hedge, and diversification, intelligent diversification, not diversification for the sake of it. There is such thing as over-diversification. And to do that across asset class, geography, maybe different countries, also including currencies if you're going to do cross markets, and then time as well, diversify time, short-term, medium-term, long-term. One thing that famous hedge fund manager Ray Dalio often said is that because there is this level of uncertainty out there, we just don't know what the future holds some of the time, especially nowadays. That's why diversifications can sometimes help as that hedge. And then last, our seventh golden rule, follow an active trading plan. Whatever plan is decided, follow it through, because that is the repetition process that is required to make sure you avoid any mistakes.
And the wonderful Warren Buffett quote that I'm sure people have heard before, rule 1, never lose money, and it said here, rule 2, never forget rule 1, which I love. Let's bring up the last chart and talk about risk attitude, because you've partly spoken about this in your 6 golden rules, but you have to have the right attitude, don't you, to risk?
Yes, absolutely, and it depends on whether trading or investing, because there are different timescales involved. The example I'm giving here is more an investing time frame, just to give a mixed sample bag for different audience members. But essentially, it's predicated on the same point. The longer we stay in a trade or an investment, the more riskier it gets. That's basically what this picture shows. And so the blue line is in the left-hand corner. The blue line is the market cycle. Rising, starting steadily and then rising, picking up pace, and then the momentum starts to peak out. So it's the average kind of sine wave cycle. And along that time, we can make low investment returns at the start of the cycle if we get in early. But it's a safe investment return, so that's the good thing about it. In the midpoint, if we follow this traffic light kind of color coding I've put on, is the optimal stage where we're actually starting to make good money and we're not taking too much risk. We're taking extra, but it's not too much. Then once the market really starts to look speculative and starts to really accelerate, as a mentor of mine taught me, acceleration is unsustainable in the short term. So always know that. At some point it will reverse. And so at that point, unfortunately, the market looks the sexiest in terms of how much money we can make, and the get-rich-quick people jump in so often in the greater fool theory conundrum. But it's at this point that we really need to be risk-averse, manage our stop losses, and the high-risk time where we just really need to get out. And that is a whole cycle in itself.
Timing is such an issue here, though, isn't it? Understanding when to get out is, well, it is the be-all and end-all potentially.
It is. I mean, it depends on. There are so many different techniques that we can use. I mean, this is basically a trend-following technique that we're employing if we use technical analysis, as I do and many people do. We can use moving averages just to give us a gauge of long-term, medium-term, and short-term. But then also just the human eye and the experience of the market, I think, is good enough. Last year on digital currencies, as an example, was a case in point. Phenomenal gains, such that we hadn't seen anywhere else. But it had, in the end, moved too much in a short space of time. Time will tell how that cycle plays out, but a good case in point for this example. And on the corner slides, just on the educational point of view, keep in mind that even if we get it wrong, that's a lesson in itself. So let's say we get the timing wrong, and I've got timing wrong several times in the past, and that's how I've built up my experience over time. It's through the mistakes. And Dr. Tharp, the famous trading psychologist, has often actually made a point not just about psychology, but about mistakes. And he says, make a list of everything that can go wrong and determine how you will respond to that situation. That will be the key to your success, knowing how to respond to the unexpected. So he actually positions himself and trains his traders to do that for the unexpected. And this feeds through to my last point, scenario planning. And this is something I spend a lot of time on now. What if something goes wrong? If the timing goes wrong, if there's a financial crisis of some sort, if there's any kind of tech issue or the computer crashing or anything that might happen, there needs to be a plan B, just so that we're prepared for that unexpected.
Ron, we've got to leave it there, but thanks for joining us, talking about a wealth mindset. That's Ron William from Intensichi.